2007, we undertook the largest drilling campaign anywhere in the world between 2007 2012. We did 650,000 meters of drilling, all of it in our Nigerian project. We went to Niger simply because it's one of the largest uranium districts anywhere in the world. The French have been mining there since the early 1970s, fourth largest producer of uranium from Madaouela River into that area. So what we have now, after doing a transaction in 2016 where we acquired Denison's African projects, it's one of the largest mineral resources within the uranium space. We have enormous exploration upside. In Niger, all of our uranium's on one of our license areas, which is adjacent to Cominac and Somayer, Arriva's mines. We haven't touched the rest. We have all the upside, downside dip towards Orano, a lot of upside on that. Same in our project in Zambia. We own 140 kilometers of strike. We have 6 major deposits, and we've got all the exploration property in between all of those. We stopped. Why? Because we already have got a 21-year mine life proven out in Niger. We've got an 11-year mine life proven out in Zambia. It's not worth drilling anymore if you've already got long life projects. We'll do that when the uranium market gets going. But the biggest difference between us and our peers is we have 2 fully permitted projects. It took us 6 months to permit in Niger. Very simple process. We gave them an IFC standard document. We sat in a room for 5 days with the community and the government. They reviewed it page by page and afterwards signed it off. Thank you very much, it's finished. Unlike in Canada, where you have months and weeks of review and discussion and everybody has a point of view. We didn't do that. We got it done a lot quicker. But that's helped us because we've got a very strong government support there as well. But the other thing we've done is put a lot of time and effort into improving our projects and making them better. And that's really our next step where we're going. We like Africa. Why? Because Africa's pragmatic. Africa is driven by commodities. Unlike Canada, unlike places like the US, where mining, while it looks big here and at PDAC, is actually a very small part of the economy. In somewhere like Niger, where it's 60% of your exports, it's a big part of your economy. In Zambia, it's driven by copper, but they want to diversify from copper as well. So we're a major project for them. It's always being talked about, the uranium development going forward. The other thing, very stable governments where we are, but also very stable law. We're driven by the OHADA law. It's a French business law, covers the whole of West Africa. So very structured, very supportive for an FDI-driven business. I've only got 1 slide in for the supply demand. I used to have about 6, but this encapsulates it. The reality is we've had a time that we had to work through inventories, and we've had a time that we've had to work through oversupply. But more importantly, what we needed was the demand side to recover post-Fukushima. And effectively, this is from the WNA, it's their reference point. And what it says is there are 440 reactors out there. There are 55 reactors currently under construction. With no guessing, these are currently under construction, and that's in the demand line. So there's nothing, we're not predicting anything else, that's what's in there. If you look at the supply side, those production cuts are already in there. So what the WNA is saying is, hey guys, you're already in a supply deficit. If you don't put anything new into place, you are going to continue to pull down inventory until such point where you will have got to buy. The big utilities like to hold in excess of 2 years. It takes that long to take their U3O8 all the way through to producing a fuel rod. And so they like to have that pipeline sitting there. What you're seeing is that post-Fukushima, guys are still buying their material. They got too much inventory, but you're seeing a sharp decline. UXC Consulting is now warning the utilities that their inventory levels are getting below their long-term averages. They need to think about it. What you have seen as well is uncertainty in the market last year. We obviously had the Section 232 working group stuff going through. The other one that caught us all out of surprise was Cameco was supposed to be buying metal. What Cameco did last year was just pull down their inventories instead and sold from inventory rather than going into the market. So Cameco making it very clear now, this year, they're going to have to come to the market to buy their material. We're also seeing an uptick already in utilities coming to the market. So things are looking good. The utilities are a lot more fiscally responsible and more educated than they were back in the last cycle as well. So in the last cycle, it was very simplistic the way they operated. Now they're working with carry trades, those kind of things. But you are seeing that demand coming through and expecting it to pick up. So where does that leave us? That leaves us where we've been waiting for quite a long time, unfortunately, which is we are ready to build. That is the reality of where GoviEx is. It's permitted, it can go on and build its projects. So the first one out of the box will be this one. It's up in Niger. Why? It's our lowest cost producer. It currently has all the infrastructure there, roads, power, water, even people. The mine next door at Cominac is on its way to closure 2021, next year. There's 1,000 employees there looking for a job. I get 10 emails a day from people in Niger looking for a job from those mines. So the people are there to work on the mine. So what we're doing though is I sat down 2 years ago and basically said, MacArthur River wants to restart Cameco at $50. We have to make this project work at less than $50. So we've basically gone back and recut our PFS is what we're doing at the moment to make it get a 20% return at less than $50. The way we're doing that is getting rid of the technical risk we've got in there and replacing it with more industry standard areas which are lower cost. I'm working on the final test work for that. So Q2, we're going to come out with an interim PFS. It's part of my full FS that I'm working towards, but you should see a much lower operating cost here. The scenarios here is you've got a great project for 21 years, but it's got to get out of the first 8. It's got to be bank financeable for the first 8 years, and that's really where we're working. Last year, we got a great announcement with the Niger government. They converted $14.5 million that we owed them into a 10% stake in this project, valuing it $145 million. It's a very poor country. It needed that cash, but it put a bet on and needed us to build a mine. That was their driving force going forward. Matanga, very simple project. Again, we're slightly different from our peers. We have more than one project. Most people are a one-trick pony. We have a second project already sitting there. It's permitted. This is a very simple open pit heap leach operation. Actually has a better rate of return than the Madaouela one. Why do I do Madaouela first? Because Matanga has a higher operating cost. And I don't want to bet on the higher operating cost when I get into production. I want my low operating cost producer debt financed and going through to the other side. We've got a good board. We've all been in this industry way longer than we should have been. We all have a lot of uranium industry. I've actually worked in every continent other than Antarctica as well, and in multiple commodities. And I've been in the banking business as well. So had a fine range. Got a good board. We obviously got Govan Friedland's the founder, so we have the Friedland family behind us as well. Dave Cates, obviously at Denison. We've got debt guys here, the whole suite. I have built mines before. Platinum Mine was the last one I built. Major companies, we are fairly liquid. We obviously trade on the TSXV. For some strange reason, we're actually more liquid on the OTCQB, which is slightly strange for a Canadian listed company, but it does tend to work that way. Shares debt, that debt is a rolling debt. We have a deferred debt with the government at the moment. We don't have to pay them any tax for the next 3 years. That's part of the agreement of wanting us to get into production. They've decided to defer all our taxes as well. So we're continuing with government support. This is really the slide that I put up here, which is the key one, and is really almost my last slide. On the left-hand side, you've got the producers. On the right-hand side, you've got the developers. The reason I put this one up, in the last cycle, the outperforming shares were Paladin and Energy Fuels. What they did, the different to everybody else, they built mines. They were the only two guys that built a mine, and why they completely exceeded expectations. If you bought the index, or you bought Cameco, you got 2,500% return. It's the big cycle. Paladin went up 10,000%, and Energy Fuels was 4,500. That's one of the differences. We're one of the few companies on that developer side that in the next 3 to 5 years can actually jump over and do that. And that's really what makes us different. The other thing you'll hear people say, don't buy in Africa. The point I'll make out in the last cycle and post the last cycle, even the 211, the 3 biggest transactions all took place in Africa. It was the Chinese and the Russians buying up properties that they could own 100% of and control, which is why you had the Hoopshead mine and the Mutanga River. So my very, very last slide. Really, just to repeat what I've said already, large resource, We're already permitted, got massive exploration upside, team that's done this before, and we've got good government support. Thank you.